Welcome to the deep dive. Today, we're wading into, well, a really complex and essential area, cooperative insurance. And we're looking at it specifically from a jurisprudential angle, using a detailed study by Hend Abdalla Mohamed Elsayeri as our guide.
That's right. And the idea is to unpack this analysis, break down what cooperative insurance actually is, how it works, and importantly, how Islamic legal thought views it.
And it's not just theory, is it? I mean, the study says right at the start, insurance is just huge in modern life now.
Absolutely. It's become almost indispensable. Think about the kinds of risks people face today. They're often way too big for one person to handle alone.
Yeah, definitely.
So some kind of shared protection, some system is really needed for financial security.
Okay, so let's start right at the beginning. How does this study define insurance fundamentally?
Well, it's interesting. It starts with the Arabic root word, connects insurance to safety, security, tranquility, getting rid of fear.
That makes sense. Peace of mind.
Exactly. That's the hope. And then, practically speaking, the study lays out two main ways to understand it. First, just as a contract.
Okay.
Simple idea. One party promises to pay another, or a beneficiary, if something specific happens, and that promise is in exchange for a premium.
So, a basic deal. Pay us, we protect you if X occurs.
Precisely. But the second view is broader, seeing it as a system.
Ah, right.
This is more like a highly organized agreement.
Yeah.
They have a large group of people all facing a similar risk. They cooperate, put money into a pot.
A shared fund?
Exactly, a shared fund. So if the risk actually hits someone in the group, the harm is lessened because the compensation comes from that pool. It's collective.
That systemic view feels quite different, more communal. What are the core parts of any insurance deal, according to the analysis?
The study points to four key elements or pillars. First, the formula, basically the offer and acceptance, usually, the policy document.
Paperwork.
Right. Then the contracting parties. You need the insurer, the company promising to pay, and the insured, the one paying premiums. And they both need legal capacity, of course.
Makes sense.
Third is the subject matter. That's the money part. The premium the insured pays and the insurance amount, the compensation the insurer might pay out.
Got it.
And finally, maybe the most critical bit. The risk, the uncertain possibility that the bad thing might happen. Without risk, well, there's no point to insurance.
The whole thing hinges on that uncertainty. Now, the study mentions three general types of insurance.
It does. Commercial, social, and cooperative. And as you said, our focus today, based on this source, is squarely on cooperative insurance.
Okay, let's get into it. What exactly is cooperative insurance, according to this framework?
So, at its heart, it's described as a group of people cooperating. They contribute amounts, and this is key. It's framed as donating them into a specific shared fund.
Okay.
And the only reason that fund exists is to cover losses that any member of the group might suffer because of a risk they've all agreed to share.
Pooling resources through donation for mutual aid. That sounds like that system view you mentioned.
It really does align with that. And the study breaks it down into two forms. There's simple cooperative insurance.
Simple? How so?
More basic. Think of a small group, maybe people in the same job, or a village. They contribute to a fund just for mutual help if one of them runs into trouble with a specific risk they all share. Management is usually pretty informal.
Like an old community barn-raising fund or something.
Exactly like that, yeah. Good analogy. Then there's developed cooperative insurance.
Okay, the more modern version.
Right. This is more organized, usually run by a specialized company. Management is technical, contracts or individual policies, even if the members don't know each other. And it covers a much wider range of risks.
So, informal community versus formal large-scale system. How do these two, and cooperative generally, stand apart from the others? Because understanding that seems crucial for the legal side.
It absolutely is. These differences are really at the core of the legal debate later on. Let's just quickly run through the key differences between simple and developed cooperative, as the study sees them.
Okay.
Management. Simple is basic, maybe voluntary. Developed is technical, specialized.
Right.
Contract. Simple is collective, solidarity-based. Developed uses individual contracts, often among strangers.
Big difference.
Scope of risks. Simple is limited, specific to the group. Developed is broad, open to many types. Membership. Simple is small, known group. Developed is large, often anonymous members.
Okay.
And here's a big one for later. The scholarly view. General agreement on simple's permissibility. Significant disagreement on developed.
Okay, red flag there.
Definitely signals complexity. And finally, profit objective. None in simple. In developed, it's meant to be secondary, not the main goal.
That scholarly view difference is telling. So what defines cooperative insurance overall, setting it apart?
The analysis highlights a few defining characteristics. First, members are both insurer and insured. That's unique. You pay in, you might get paid out from the same pot you contributed to.
A closed loop, sort of.
Kind of, yeah. It aims for lower cost, partly because profit isn't the primary driver, and maybe lower admin expenses.
Right.
There's flexibility. Contributions might need to change if claims are high. Members could even be asked to chip in more.
So it's not necessarily fixed premiums?
Not always. Depends on the structure, but the principle allows for it. There's no fixed capital like a normal company. The goal is mutual security through the shared fund.
Okay.
And fundamentally, this is crucial. It's framed as a donation contract. It embodies takaful, which is mutual support, solidarity. It's not about members profiting from risk.
So built on community, mutual support, covering losses, not making profit. How does that compare against commercial and social insurance? Why is that comparison so vital legally?
It's vital because the legal permissibility hinges on whether its core nature is truly different from, say, commercial insurance, which often faces objections. Let's compare cooperative and commercial first.
Okay.
The core relationship is different. Cooperative is based on donation among members. Commercial is exchanged. You pay a premium to a company. They promise compensation.
Donor versus buyer.
Essentially, yes.
Yeah.
And that affects the financial elements. Cooperative aims to avoid riba, interessery, and gar, excessive uncertainty, precisely because it's donation-based. Commercial, being exchange and profit-driven, is often seen as containing these.
I see.
The status of members differs too. In cooperative, members are the participants. They own the fund collectively. In commercial, the insurer is external. The company owns the premiums and benefits most, especially from investments.
Right, the profit motive.
Exactly. Any surplus in cooperative goes back to members. In commercial, surplus is the company's profit. Commitment. Cooperative payout might depend on the fund's health. Commercial usually promises a fixed amount, which, the study notes, can be risky for the company itself. Premium ownership. Cooperative premiums belong to the member fund. Commercial premiums belong to the company.
Big distinction.
Investment profits. Cooperative members get the benefit of investing the fund. Commercial company keeps investment profits.
Okay.
And member incentive. Cooperative members have a stake in keeping risks low because claims affect their surplus. In commercial, that direct link isn't quite there for the insured.
Wow. Okay, that's a very clear contrast. Donation versus exchange changes the whole dynamic. What about social insurance? How's that different?
Social insurance is different again, but in other ways.
Yeah.
Its legal basis is usually a state law, part of Social Security. Cooperative is a private financial contract.
State versus private contract.
Right, participation. Social is often mandatory. Cooperative is generally voluntary.
Okay.
Funding. Social often involves state contributions alongside employee-employer ones. Cooperative is funded only by its members, the insurer. Social, it's the state or a state body. Cooperative, it's the association or the managing company acting for them.
Got it.
Risks covered. Social targets specific social risks, old age, disability, unemployment. Cooperative can cover a huge variety of risks. And the obligation. Social insurance obligations are legally mandated. Cooperative compensation, again, depends more on the fund's status.
Okay. So 3 distinct models: commercial, exchange profit, social state welfare, cooperative, voluntary mutual aid. That really sets the stage. Let's get to the core legal question: the jurisprudential view on cooperative insurance.
Right. And this is where the analysis digs into the legal structuring, the Fiqh of the developed cooperative model. The study says scholars generally see it as a blend of 3 contracts working together.
3 contracts rolled into one. Sounds complicated.
It might seem so, but it reflects how a formal system operates. First, there's agency, wakala. The managing company is just an agent for the members, handling operations, admin, claims.
Makes sense. They need someone to run it.
Exactly. Second, often there's mudaraba, profit sharing. If there's surplus money in the fund, it gets invested based on Sharia rules, and profits are shared between the members and the managing company according to an agreed ratio.
Okay, so investment is part of it.
Can be. And third, the most fundamental layer, donation, tabaru. The actual agreement between the members themselves is based on mutual donation and solidarity. They pool resources to help each other out.
So the member-to-member relationship is donation, but the operation uses agency and maybe profit sharing for investments.
That's the picture, yes.
Okay.
Now, for the ruling, the study first tackles simple cooperative insurance. And here it's clear. Scholarly consensus among contemporary jurists says it's permissible. Consensus. That's strong. Why such agreement there?
Because it aligns so directly with core Islamic principles of takaful mutual support, cooperation. The evidence cited is quite compelling.
Quranic verses urging cooperation in good deeds. Numerous hadith, prophetic traditions that emphasize believers supporting each other like one body or a single building, saying Allah helps those who help others.
Powerful imagery.
Very. And stories of the Prophet's companions practicing this, the Ash'ari sharing food in hard times, an army dividing provisions equally.
Real-life examples.
Exactly.
Yeah.
Simple cooperative insurance is seen as just, putting these principles into action. The study even draws a parallel to the historical Aquila system.
What was that?
Where a tribe or family group would collectively pay blood money if one member was liable. That was also based on mutual support, donation to cover a harm, and it was legally accepted. So, simple cooperative is seen as pure cooperation, donation-based, free from riba, gharar, qimar.
Okay, solid ground for the simple form, but you flagged disagreement on the developed form. Let's unpack that debate. What are the opinions?
Right, this is where it gets complex. For developed cooperative insurance, there are two main camps among contemporary scholars. First, the majority view, according to the study, it's permissible.
Okay, the majority says yes. Why?
They essentially extend the reasoning for the simple form. They argue the core nature is still cooperation and donation, takaful, even with the complex structure. The agency and mudaraba are just tools to make it work on a large modern scale.
So the underlying spirit is the same.
That's their argument. They see it as fulfilling the Islamic call for mutual aid in today's world, where traditional support might not be enough for modern risks.
And how do they handle the potential issues, the riba gharar concerns that often come up with insurance?
Good question. They address them by arguing that while some elements might look like uncertainty or imbalance, they aren't the primary goal or intended purpose like in commercial insurance. Any gharar or potential riba-like imbalance is seen as incidental to the main aim of mutual aid through donation.
Abaru. So the donation intent overrides those concerns for them. What about the other side, the minority view?
The minority view holds that developed cooperative insurance is prohibited.
Prohibited. Why? What's their reasoning?
They tend to look past the cooperative label and focus on the structure, arguing it functions more like an exchange contract, muawada, similar to commercial insurance, rather than pure donation.
And that exchange nature is the problem.
For them, yes. They argue this structure inevitably brings in forbidden elements.
Like what, specifically?
They point to several things. First, riba. They see riba al-nasiya, interest on delay, because you pay money now for potential compensation later, an exchange of money for money deferred in time. And riba al-fadl, interest through unequal exchange, because the amount paid in premiums could be vastly different from the compensation received, or you might pay and get nothing back. This unequal exchange of money for money is a major issue for them.
That riba al-fadl point seems quite direct, paying $500, getting back $50,000, or zero. How does a majority counter that specifically? Seems like a clear imbalance.
That's a central point of contention. The majority counters by stressing, again, the donation aspect, tabaru. They argue the premium isn't paid in exchange for a guaranteed return of a specific value. It's a contribution to a mutual aid fund.
Ah, so not an exchange transaction in their view.
Exactly. They argue the rules of riba that apply to strict exchanges don't apply in the same way here, because the fundamental basis is donation and cooperation, takaful. The compensation isn't seen as a direct counter value for the premium, but as help from the collective pot based on the agreement to support each other. It's risk-sharing, not profit-seeking exchange.
Okay, so that donation versus exchange classification is absolutely pivotal.
It really is. The minority also points to gharar, excessive uncertainty. You pay premiums without knowing if you will get anything back or how much or when.
Right.
And some argue qimar, gambling, is involved the speculative element where gain or loss depends purely on chance, on an uncertain event happening.
So they see the financial mechanics as just too similar to forbidden transactions, regardless of the cooperative intent claimed.
Pretty much. Some in this camp also argue that traditional Islamic mechanisms like zakat, charity, and the public treasury, Bayt al-Mal, should be sufficient, and creating this new system isn't necessary.
Okay, so the whole disagreement boils down to how you legally characterize the contract, the takif fiqhi.
Exactly. That's what the study identifies as the core reason for the split. Is it primarily donation and cooperation, where some uncertainty is tolerated for the greater good of mutual support? Or is it primarily an exchange, where elements like riba and gharar become critical problems? The perceived intent matters hugely too.
And where does the study itself land? Which view does it find more convincing?
The study leans towards the majority view, permissibility, as being the stronger.
Sure.
It argues the evidence supporting cooperation and mutual aid from the Quran and Sunnah is very strong, and that the way this view refutes the counterarguments, especially by anchoring everything in the principle of donation, tabaru, is more compelling.
So prioritize the underlying meaning and intent of mutual support.
Yes. But, and this is a really crucial practical point the study makes in conclusion,
Yes.
you absolutely have to look at the actual contract and the real practices of any specific company calling itself cooperative or takaful.
Meaning the label isn't enough.
Not at all. If a company uses the name, but in reality its investment strategies heavily involve riba, or the way it handles compensation is structured with excessive gharar as a primary feature, or it operates mainly for the profit of the managers rather than the members.
Then it's not really living up to the principle.
Exactly. If its practice mirrors forbidden commercial insurance, then even with the cooperative label, it would likely be deemed impermissible. It has to genuinely embody cooperation and donation and actively avoid those forbidden elements in its operations.
So the implementation is key. The details really matter.
They really do. The devil is in the details, as they say.
This has been fascinating. So insurance is a modern reality for risk. Cooperative insurance comes forward as this potential Islamic alternative grounded in mutual aid, donation, takaful.
Right.
But the legal rulings, especially for the modern developed form, show this really nuanced debate among scholars. It all seems to hang on the contract's true nature and intent.
And, like we just said, requiring a hard look at how any specific provider actually operates in the real world.
Absolutely. You know, as we wrap up, it makes you think. These different ways of approaching insurance, commercial, social, cooperative, they aren't just financial tools, are they?
What do you mean?
Well, they sort of reflect deeper ideas about risk, sure, but also about responsibility, community, even how we view wealth itself. Are we just individuals buying protection? Does the state owe us a safety net? Or is there this more fundamental duty for us to collectively share risks and support each other when loss hits?
That's a great point. How would things look if our financial systems were genuinely designed around that principle of mutual aid from the ground up?
Exactly. Something for all of us to think about.
Indeed.